The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Larry Pesavento.
Okay, good afternoon, folks. We're going to be talking here a little bit about crude oil to start the day because there's so much interest in the markets about crude, and everybody's saying that so goes crude, so goes the market. Boys and girls, let's be realistic, okay? Crude oil has been dropping since July. That's when the New York Stock Exchange Index topped, on July the 3rd. That's a historical date because that's the bottom that we made in 1932. That happened on July the 5th. So I think that's an important time. Now, we made higher highs in the NASDAQ. We made higher highs in the S&P, and we made higher highs in one other one. I think the Russell didn't do it either. But the Dow Jones and the NASDAQ certainly did. And the S&P did, too. So what I've posted in here is the fact that we've had several times here where we've looked at these things, and one of our friends in the den, and this is one of the reasons why being in the TFNN family is so important, is the fact you got some really smart people in there. And Mr. RK sent me an email showing me that there were not just 630 stocks that were moving the market higher. It was frankly only 521 because of the double counting, because some stocks in the S&P are also in the Dow and in the NASDAQ. And if you take out those 110 stocks, there's actually only 520 stocks that did all this moving to the upside. This is all changing now, as Basil pointed out. You know, we've had a pretty big break in the market now. We're down, I think, 3 or 4% at least, and we've broken the key level at 17,500, which should act as resistance when we do get a rally in here, and we will get one. I'm pretty sure of that. The question is when we're going to get it. We have broken some really serious levels from a long-term charting perspective that we've looked at, of course, with the NYSE and the S&P and the Dow Jones. Those levels came in at 17,500 in the Dow, of course, and at 2,055 in the S&P 500. Now, if we take a look at this from a perspective of what's happened since the market turned down in July, and when the market turned down in September, when we had those corrections, folks, we have turned down harder. This is the hardest weekly drop we've had since 2011. Which was the last really major correction we had, which was a 38% of the whole move from 2009. But the way we've come out of here tells us just look to the south, because we're going lower. It really makes no difference when we rally or how much we're going to rally, unless we take out those highs that we made, just recently at 17,900 and change in the Dow Jones. If we do that, then I'll turn in my chart pencil and move back to the 200-day moving average system that I've developed over the years. I have that for sale for $50,000. Oh, I just found out that we've sold our last unit on that, so that trading system is no longer available for us. Now let's get to crude oil. Crude oil has been dropping rapidly since July. All during this time, we've had rallies. There's been 6 of them, of $4 a barrel. Last night we opened lower. We rallied $2.50 a barrel. It's just having a little bit of a rally and then more to the downside. So there's not really much you can do but trade the short side and look at the smaller term. Look at an hourly chart. Look for the ABCD patterns, because you do find them. It's just that the market is in such a downtrend that we've only had one up week since July, folks. This is a bear market. Any way you look at it. Now, if you look at the long-term weekly chart, we broke below the $65 per barrel level, which was the 61% retracement. The only thing holding it up now for a potential type of support is the 51.50 level, which is the level of the 786 of that move. But that doesn't necessarily mean that's going to hold. That's just one of the numbers, that we happen to be watching. Remember, folks, historically, oil is really, really wild. I mean, it really has a history of going crazy. If you remember back in the Iran-Iraq War, it wasn't Iran-Iraq War, it was Desert Storm with Iraq. Oil was trading at $42 a barrel, and when the war only lasted, 24 hours, oil dropped from 42 to 31 on the first day, and it went all the way down to $10 a barrel later in 1991. So oil can go a great deal lower. We had a bottom at $30 a barrel. Frankly, that might hold, it might not. I don't know if that's going to be the case or not, but I really believe it's got a chance to hold at the 786 level. That's what I'm looking at. So those are the things that I'm keeping my ear to the grindstone on right now. What really amazes me is the fact that the VIX index has not gone crazy to the upside. That's the real thing that we're looking at here. So our first question from our callers is about the Japanese yen. And where I think we're looking at as far as a bounce. We've had a tremendous volatility in the yen over the last 3 or 4 days. We went from 122 down to 117, and 117 up to 120, and all of that is telling us that we have greater volatility coming into the market than we've been expecting in a long time. Now, what I would like to do is to go to a little bit shorter term chart here. And I will get this up here in just a second if I can find it, giving me, there we go. Actually, I want to show the longer-term chart because this is the one I think is more productive of what we're looking for here, and that is that on the long-term chart, the dollar or the yen versus the dollar follows the Nikkei Dow. And we completed a major 3 drive to a top pattern up in that Nikkei up at 17,900 and change, which was almost, in fact, we hit 18,000 as a matter of fact overnight that last week, which is also a double top from 2007. Folks, if you look at these charts, I'm just a technician. I don't know diddly squat about the fundamentals. Never thought I did. Never wanted to know. But you just look at the charts. They have they look bearish. I mean, that's just flat out. You've given up 100 points in the S&P in a matter of 8 or 9 trading days. This is not a good sign. I think we're going to take out the October lows, and very, very quickly. We haven't even had any type of this has been a very orderly sell-off because we've had really strong breaks and rallies of 40 or 50 points in the S&P and then back down again. So it's a very orderly market. We have not had a meltdown yet. We've had melt-ups on the way up, of course, starting in February of the year, but we have not had a meltdown. And that's, I think that is coming. I do believe, I've said this in print, I've said it on the show here, that we will see a day that will break the record of the Dow on the downside, which is 777 points. And sometime during this time, right after that, we'll probably break the record on the upside, which is 880 points. That's how much volatility we have going, right now. What is surprising to me is when I was listening to Basil's show is the fact that, this last rally that we've had in the VIX, went right up to the 61% of the October high. I mean, we really didn't go crazy here. So I was really surprised at the fact that there's not much fear in the market at this point, at least not yet. And it'd probably take a little bit more impetus to the downside to see if it's going to happen. But I believe we're in a 6 or 7 day down move, almost 8 days, because we should be down 2 weeks, and then we should get a rally. But this is the first week down was such a bad week. Folks, this is a part of a bigger scenario, somewhere between 1 and 7 weeks or maybe even more, taking us into the new year without any trouble at all. We have a lot of statistics coming up about the Santa Claus rally. We have a lot of statistics coming up on the January effect, and I'll go through those later as we get closer to it. And that's what we're looking at. We got a caller from Clearwater. It's our friend Dave. Dave, are you there?
Yes, sir, Larry. Glad to see that from the sound of your voice that you are feeling better.
I am feeling better. I feel okay. It's just my voice has just been, not very good. That's the real problem. But other than that, I'm doing pretty good.
You sound better. I mean, you know, I get your emails here, and I've been listening to a couple of your videos, and it's like, wow, I hope he feels better than he sounds.
I do feel better than I sound, for sure. Unfortunately, I gave everybody in the family the same thing because I love them so much, and so that's one of the things you have when you got little kids. It's a little culture tube all the time. So,
well,
what can I help you with, my friend?
Well, just remember that sharing is caring, especially when it comes to germs. Anyways, I was wondering, following gold, as you know.
Yes.
And as I've stated before in the past, I'm bullish on gold. I've been bullish since we had a real nice reversal on the 7th of November. And for disclosure's sake, I'm long gold in a pretty significant way. So far, I mean, I'm seeing a real, a nice move. One of the things, though, that is slightly concerning to me is we're not seeing, at least what I would like to have seen, is this sustained increase in open interest. Is there any statistics or, in your experience, been anything to lead to, if you don't see, significant increase in open interest, that it leads one to conclude that it's a short-covering rally? Because I know when you have a short-covering, you would expect open interest to decline, and we did see that as people were, getting out of their short positions. But we haven't seen a follow-through increase on open interest on gold that would at least, give some level of secondary support to the price movement that we're seeing. So I was curious for your thoughts on that.
Yes, it's going to take me more than a minute or two to answer that, Dave, so stay with us till we come up to the commercial break, okay?
Yes, sir.
Because we have to pay some bills here. But I posted into the Tiger TV what we've done over the past 2 weeks. And as you can see, as of today, we just made our low today came in at 1208. That was the 61% retracement from the low we made back on December the 7th. On December 7th, you remember that was a sell-off of $34 an ounce that came in at the 382 retracement. If you remember that, we talked about that on the commodities show last week. So now we had a 382 retracement on December 7th, and it's taken 6 trading days to get down $34. And when you think the market is wild as it is, I think that tells you that there's a lot of buying in here. I was a buyer of gold today at 1208. Because it went right down to that number, held there for about 2 hours, and now we're trading about $7 or $8 higher. And as long as we stay above 1208, I really think that gold's got a chance. Your answer about the open interest is very tough for me because I'm not an open interest person. The fellow that's probably the best on that is a fellow named Steve Breeze. He works with Jim Flanagan out of GAN Educators, and I haven't been able to contact him to ask him about it, but you're right. We have not had any substantial increase or decrease in gold or silver open interest, since this whole thing started. Dave, we're going to make a correction here, or a commercial here. We'll be back, okay?
Yes, sir. Thank you.
Still got the Dow under pressure.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com. Check out the new look of Tiger TV. Now you can see all hosts, charts, and computer screens live in high definition. Whether it's Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Think or Swim, or Daryl Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV. Now, crystal clear in high definition, 24 hours a day, 7 days a week. If you haven't seen the new look of Tiger TV, then visit TFNN.com. Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on Chinese stocks, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, folks, we're back with our friend Dave from Clearwater. And Dave, I've posted into Tiger TV the chart of silver going back to December 7th. And as you can see, we've just barely made a 50% retracement over the past 7 trading days, whereas we made a 61% retracement in gold. You know, silver has only made a 50% retracement, and silver has really held up, incredibly well. You stop and think that it's moved, $15,000 a contract, since that October bottom, and that's going to be a real interesting one when we finally do get a severe correction.
Right.
And when we get it, I don't know. Now, going back to your question about open interest, the one thing I can remember from my years of experience is that gold and silver have a tendency to have a very large cash following. In other words, people don't want to own futures. They literally want to hold the metal in their hand or in their bank or in their safety deposit box, under the trunk of their car, wherever it happens to be. They do want to physically hold the gold. So there's a large cash business. I know from personal experience, because I like to get silver coins for the kids, for Christmas and stuff. And if you want to buy a good quantity of silver rounds, the 1 ounce rounds that they have that are equivalent to what the old silver dollars look at, you have to literally put an order in. And they usually don't have more than 40 or 50 of them in stock at any time at the major stores here that I'm looking at here. On the East Coast in Philadelphia, where I've looked, but it's really amazing the fact that it's held up, so well, and it's hard to get the physical silver itself. So that might be an indication of something that is happening too.
Right. Well, I'll tell you, Larry, from a technical standpoint, I'm liking what I see, and I did notice the silver chart is more bullish than the gold chart. But Larry, I cannot, under any circumstances whatsoever, bring myself to take a contract on silver. I just can't, because I get smoked every time, and I feel I've lost more money trading silver.
Then don't do it.
Yeah, I can, man. I won't. Let me put it this way: I won't. I can, but I won't. And I've just gotten burned more times than I really care to mention. And so, anyways, but yeah, I did notice that it did not make near as much of a retracement on as we saw with gold. And the flip side to it, and I realize you're not a big fundamental guy by any stretch, and I get that, but just from a fundamental standpoint, and Tom's really done a great job in his gold. I take his gold report also, in laying out some fundamental demand cases in India for gold. And in addition to that, I'm convinced, I could be wrong, I may be the only one in this community that feels this way, but I strongly am convinced with all the bond purchases that the Federal Reserve has been doing, combined with the fact that I believe the economy is, while not going gangbusters, it is doing better than the average American would have you believe. I think plus some stimulus from the drop in oil prices, I think it's going to act as an additional stimulus into the economy. And at some point in time, Larry, maybe not in my lifetime, but at some point in time, this massive printing job that our friends Mr. Bernanke and now Mrs. Yellen have brought to our world will generate inflation. I'm convinced of this. It's just a matter of when. And I think also from a fundamental standpoint, that's going to put some significant price support in a bullish case for gold. And lastly, the fact that the dollar has moved the way it has moved, and until things change, the majority of gold trades are denominated in USD. And the fact that gold has not gotten destroyed is pretty impressive.
It's more than impressive because, they talk about, oil as being black gold. And if that were the case, gold would be trading at about $8.50 instead of, $12.10 or $12.15. So that's another reason behind it. But I do follow Tom's report, because his work in gold has no equal. And any man that can call the bottom in the Japanese yen like Tom did at 75, you have to respect his work in gold. And so I tell folks that, if you want a good letter on gold, you really ought to, take Tom's letter, because he really understands it. And he understands the gold stocks, which I certainly don't. I just, look at the charts and, see if they're following, certain numbers or something like that. But, frankly, Dave, I know you think this might be crazy, but I really think we got a shot at $3,500 gold. I
don't think that's crazy at all.
I just feel it in my bones, and I've been long gold forever. I started trading gold in '72. I still have the coins that I bought then, and I tell you, when I look at this and I look what's happening to the this printing that you talked about, then that's going to end badly no matter what. So listen, we got to take a little break here. But thank you for calling in, my friend, and happy holidays to you, Dave.
Merry Christmas to you as well.
You bet. Bye bye.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 8 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, folks, I'm going to talk a little bit more about the crude oil market, but we're going to do it through the eyes of the Canadian dollar versus the U.S. dollar. That has a correlation of better than 90%. And so what we're looking at here in the Canadian dollar, also known as the loonie, and I think that's from Walter Lance. I'm not sure, but I'm just teasing. That's the name of a bird. But anyway, as you can see, that we're making some really strong retracements on the long-term weekly chart. Now, if we go to a different chart that shows the just the Canadian dollar by itself, you can see we're very, very close. We're within about 30 pips or less of the exact 61% retracement on the Canadian dollar on a weekly basis at 116.80. Whether that's going to be the final top on this, I'm not sure. But at that, well, you're never sure, folks. But at that point, you have a beautiful ABCD pattern forming there. You've got the 61% retracement coming in, and so it's going to be a real interesting one to keep an eye on, at least from the standpoint of what we're looking at with these different things that we're watching. I wanted to show you the relationship here between we're almost there up here at this. Just give me 1 second here to show. I'm going to show you the relationship of crude oil, to the Canadian. You can see it has an incredibly high correlation. You're basically, when you're long Canadian, you're short the oil. That basically what that amounts to. And as you can see, that the correlation is incredibly high, and we've had this big move up in the Canadian and the big drop in oil, which you're supposed to see. We're close. It might be the Canadian dollar that turns the oil market, or it might be the oil market that turns the Canadian dollar. I'm not sure which is more important, the country or the fact that almost everybody on the planet in the free world uses crude oil quite a bit. Now we're having the same problem in the overall market for crude oil. It's also exhibited in the natural gas. Well, not natural gas, but it's shown in the heating oil complex is also breaking down badly. Gasoline futures are also breaking down badly. So that gives consumers more income to spend, and we'll see what happens with that. Someone asked me a question about Apple. Apple's holding up relatively well in this 110 area. I frankly think that's would be the best trade of the year. Would be buy a put on Apple for July or something like that. Way out of the money put that you could probably put a few $100 in, and if you get it right with this big steep run we've had, it could pay off. Much like when it was bottoming down at 385, you could have bought a 440 put for almost nothing, and that thing went up tripled or quadrupled in price once it started to move. So that's the kind of move that you look at some of these things. But frankly, I don't do puts and calls very much, and I don't want to recommend very much of that. So that's the bottom line. Someone's asked a question about the cattle market. We've been following cattle through our friend Rich Anderson and Anderson Capital Management, and he mentioned that we went below 169 in cattle. We could easily be looking at much lower prices, and they've broken about 10 cents 10 cents an ounce from 10 cents per pound, which is roughly $4,000 from that level. So again, Rich was a big help in helping us spot some of these things that we're looking at. We'll have to keep an eye on some of these commodities because some of them, like oil, have been in a free fall. Gold and silver have certainly gold and silver have stood up and said, "Hey, look at me." I mean, after this bottom came in, we had a tremendous rise in very much. So you have to pay attention to that. Okay, someone has asked a question about the overall way the Bradley model looks. Well, we had a Bradley model date that came in on the 15th, which happens to be today. I'll post that into the Tiger Den to let you look at it, because we should be making some type of a bottom if this is going to be the case in the gold and silver, and we might, the Bradley is related to the stock market. In other words, the Bradley model is showing that we should be looking at a bottoming formation, some type in here. Basically, what we're doing in the Dow is making a 382 retracement, and remember, these rallies that we get are going to be really wild and vicious, folks. They're going to be, really something to see unfold, and you'll take a look at what we're looking at. Okay, we've had a request from one of our folks in the Tiger TV family to take a look at the XAU, which is the gold-silver index, and I'll be happy to put that up here. I'll do it first with the daily chart, and then we'll move on to the weekly and take a look at it, because it's actually, it's down on the day today, which is quite surprising since gold's held up relatively well, but it's making a nice little Gartley pattern today in the XAU. I'll draw that in so you can take a look at it, and certainly here your risk is going to be very, very small. We're almost at a perfect 61% retracement pullback in the XAU, and the HUI, which is the bull-bear index for the gold, looks exactly the same as what we have here. So we should hold the 67 level. If we go below 61, I would think this is not a very good signal to look at. But we've had a pretty good rally. We backed off a little bit. Now, if you look at gold and silver, the gold-silver index has backed off quite a bit. Now, I believe the reason for that is that once stocks get hit, they don't take any prisoners, whether it's a mining stock or whatever it is. Everybody's trying to, raise assets, and so they're selling stocks, whether it's a mining stock or not. But with the silver and the gold, they kept going higher. We just made a higher high last week at 1240 in the silver. In the gold and 17-something in silver, yet the XAU and HUI backed off a little bit. Well, that's just a function of what's happening in the overall bearishness, of the stock market. That's, really what you're looking at when you're watching that, as near as I can tell of looking at this. So we'll keep an eye on it. But gold has really done very little today. It went down to 1208, rallied up to 1218, and we're back to 1208. So maybe the 1208's not going to hold, and we're going to back off some more. That's certainly a possibility, but we'll have to wait and see if that's going to be the case. So far, there's not really much happening in either gold and silver today. They've basically been in the same range here for the past few hours. All right. Now if you have any questions, it's 877-927-6648, and we will see the silver is actually making a new low on the day today, right near that 50% retracement again, and gold is pretty much doing the same thing. We've made newer lows in crude oil, which we've certainly been expecting that. But we'll see how this gold and silver is going to hold this 1208 level, because below that, we're looking at somewhere around $13 lower in the gold, would be around $11.95 per ounce. And believe me, maybe that 1240 was the last of the rally. You can't really say yet. The fact that it hasn't given up very much is important. That doesn't mean that that's not going to happen that way. So that's the key to what we're watching when we're looking at some of these things. So the next question that someone had was about Apple. Folks, I just mentioned, Apple has held up, relatively well. We had a high of 118. We came down to 109. We're trading, closer to the low than the high. The overall pattern in Apple on the long-term weekly is nothing more than a 1.27 expansion. Here again, it was one of those stocks that led the market up, of those 520 that have been leading the market higher, and the rest of the market has been going lower. CNBC had a special on Friday that I thought was very interesting. It was at the end of the day, and I happened to be, trying to catch some end-of-the-day prices, and the gentleman came on, and he showed the 10,000 stocks of the 60 major countries of the world. There are 9,800 stocks that are considered the most liquid and most heavily traded and the most highly capitalized of all the stocks in the world. And on a long-term basis, over 1 year, these stocks are down 24%. And they would be down even more if it weren't for the fact that the New York Stock Exchange Index was up on the year. The rest of them, really made it look, quite a bit more worse than it actually was. So you'll basically, take a look at that to see what's happening. I want to switch over to bonds for a second, because we have some really interesting chart pattern here in the bonds as it relates to the junk bond market. We've been talking about, they didn't call it junk bond for no reason, folks. They can call them high yield if you want it, but their junk is still junk. And we'll show you what this chart looks like. It shows we've talked about this over the past week, so this is nothing new, but I wanted to review it because of the fact that we are, we're in a basically free fall in the junk bond market. I'm going to post this chart, and we'll take a look at it. As you can see, the yield on the 30-year Treasury bond has been dropping, and the yield on the junk bonds has been soaring. And that's the way it should be, because, it's a high-yield bond, but it's still basically, not anywhere AAA or anywhere even close to that. And that's where I think the big problem lies. It's not just a stock market that's in trouble. This is a credit market that we have in trouble, and that's really what we're really following right now. So we'll watch how this unfolds. As we're on the air right now, we are within about 15 pips of the exact 61% retracement on the long-term weekly chart on that Canadian dollar, U.S. dollar. So if crude oil is going to hold in here, this is where it's going to have to, put up the, circle of wagons, because, if it doesn't hold here, we're going to be heading to 52 or 51.50 a barrel in crude oil over the next few days is the way it looks like from our standpoint. We've rallied about 17 points here in the S&P here over the last since we've been on the air here, and that's nothing more than another little rally that we've had all along, just like the one we had last night that went from 1992 up to 2011. It rallied 19 points. This one's rallied 17 points. So these are just normal rallies, that we're seeing, all along the trail here as we move lower in the stock market. I believe we're going to take out the October lows in the stock market. That's a very, very far, far way down, folks, so be really careful. We have done something that we have not seen ever in the stock market, and we had those three major divergences in the New York Stock Exchange Index. I'm going to put them in here probably for the last time, because I get complaints for people saying, gee, I get tired of seeing the same chart. Well, this same chart is the one that is going to keep you from, getting demolished. Because if you look at this chart, folks, of the New York Stock Exchange Index, the broadest measure of stocks that we have, you'll see that we had a major divergence in July, we had a major divergence in September, and we had a major divergence again here in December. And this one has come off more sharp. Folks, we have dropped more in these past 5 or 6 trading days than we did in the whole month of July. And we did that in just a few days. And look at the steepness of the line from September through October and what we're doing right now. We're even coming down at a faster rate than we did when we made that monster bottom back on October the 15th, when the Bradley model was calling for a bottom. So the Bradley model is calling for a bottom today. If that's the case, it should hold. We should get a little bit of a rally, and then we'll find out, what happens to it after that point. But remember, the Bradley dates are very accurate, but they certainly are not foolproof. That's one thing that you got to remember, that's not the way it's going to be. Someone's asked a question in the den about the Saudis being able to control the price of oil. We already know that that's not possible. And that's the same thing that the Federal Reserve is trying to do, folks. They're trying to control interest rates for us. And I know they're bigger than the Saudi oil production, but the same thing usually happens when someone tries to do something against nature's law. And nature's law tells us that we should be looking at higher interest rates and not zero interest rates that they're giving the banks and the people that can't afford the interest rates. Those are the ones that are still getting hosed, because they haven't dropped the interest rates on credit cards by very much. Car loans are about to zero, which is pretty good, but the rest of it is still quite high. Got the stocks coming back a little bit, and we got gold making new lows on the day. We'll be back to close this up in just about 3 minutes.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you like it does me, visit everbank.com/TFNN to find out what they can do for you. Again, that's everbank.com/TFNN. Visit them today. Everbank is a member FDIC and equal housing lender.
TFNN has just announced a special sale for the Gold Report for a limited time only. To celebrate the 660th weekly issue of Tom O'Brien's Gold Report, that's more than 12 years, TFNN is having a special one-time sale. Right now, you can receive 60 weeks of the Gold Report. That's 14 months for only $600. We're offering Tom O'Brien's dynamic weekly newsletter at only $10 a week, half off the regular monthly price. By taking advantage of this special offer, you also get a signed copy of Tom O'Brien's best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, an $88 value. The Gold Report is published every Tuesday and provides subscribers with Tom O'Brien's expert commentary on the industry, as well as detailed information on a variety of mining equities. This offer is valid for current or new subscribers, but is only good through this week and ends this Sunday, December 21st. Lock in the low rate of only $10 a week for the Gold Report by placing your order at the front page of TFNN.com today. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy, a set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders, take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
Up next, the Diagnostics Trading Hour with Daryl Martin here on TFNN.
Okay, folks, I'm going to post a chart that my partner Bart follows quite a bit, and that's the chart of palladium, which is the chart in the dark color. And then if you look at the correlation to Apple computer, you'll see that Apple actually has about a 85% correlation with the price of palladium. I have never traded palladium before, but the reason I understand is because it's related to the amount of palladium in the electronics that they have. So whether that means too much from this point or not, I don't know, but it really has a strong correlation. And so we'll see what's really happening. The one that really has my interest right now is this Canadian dollar. We are really close to the 61% retracement at the 16.55 level on the long-term weekly chart. So it's going to be interesting to see if it actually holds that level or not, but we'll be watching it very, very closely. Longer term, folks, we are looking at lower prices in stocks. There's no other way. We need a 3-day rally or something just to see what the quality of the rally is, because you'll notice in the morning the market's 150 points higher, and an hour after the opening it's fighting for its life, making new lows on the day. That's not good bullish action, folks. So, just protect yourself. We've broken through some major support here, but this is only the first week down, was last week, with the worst week since 2011. This looks very, very ominous because of the speed that it came from. And the reason why it looks so ominous is the fact all those bearish 5-point reverse wave patterns that we had, the 1, 2, 3, 4, 5 patterns, those are the ones that make you look like you're a hero when they work. Unfortunately, nothing works all the time, but it looks like we're getting ready to have a really, really severe correction in the stock market, and this could be the one that really puts a really big dent in some people's outlying views of what's happening in the market. When you stop and think that worldwide stocks are down 24%, when you look at all 60 of the major countries and the 9,800 stocks, it's only the 520 stocks of the S&P, the NASDAQ, and the Dow that have been making new highs. The rest of them have done no good. We've got a double top in the Nikkei. The Chinese market, looks like a flying Walinda. The emerging market, which everybody says is going to bail us out, it looks even worse than the market for the Chinese market. So we're not getting any help on a global basis from what we're looking at. So we've got to be very, very careful here of things that we're looking at. I'm going to post the emerging market one. It'll be pretty close to the last chart of the day, I believe. But you can see that the emerging market, and it's down again today. This is the ETF, and you can see that we had just a very minor rally during September, November. It didn't even make a 382 retracement, and then we've broken badly. Totally different than what they're telling us on CNBC and on Bloomberg. They're saying that the emerging markets are going to be the ones that pull us out of this, and frankly, the charts are not telling us that at all. That's for sure. The big news, of course, is crude oil. I mean, that's one that's taking the forefront of the news. It's even more so than stocks because, everybody's talking about how bearish it is and it has no hope at all. Well, that's when you usually have hope. So I am looking for a bottom in crude oil, primarily through the eyes of the Canadian dollar because of the strong correlation there. So we're within just a few pips of that magical price. That doesn't mean it's going to hold, but this is going to be interesting in what we're looking at. So live every day in an attitude of gratitude, and may God bless.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
You're watching Tiger TV.